You know what keeps me up at night? It's not the stock market. It's not even gold hitting new highs. It's what's happening right now in the bond market that nobody's talking about. And if you're retired or getting close, this might be the most important thing you hear all year. Let me paint you a picture. Right now, as I'm recording this, the 10-year Treasury yield just did something it hasn't done in over 2 decades. And the last time we saw this pattern, retirees who ignored it watched their purchasing power evaporate by 40% in less than 3 years. I'm not trying to scare you. I'm trying to wake you up to what the smart money already knows. See, there's this thing happening in the bond market that's like watching a slow-motion train wreck. The yield curve, which has been inverted for months, is starting to steepen. Now, if you're not a bond trader, that might sound like technical jargon, but here's what it really means. The bond market is screaming that inflation is coming back with a vengeance, and the Federal Reserve is trapped. Let me explain why this matters to you. When bond yields rise, it means bond prices are falling. And if you're like most retirees, you probably have a chunk of your portfolio in bonds because your financial advisor told you they're safe. But here's the dirty secret nobody tells you. Bonds are only safe if you hold them to maturity and inflation stays low. Right now, neither of those things is guaranteed. I was talking to a retired couple last week, Jim and Susan, both 68 years old. They've got about $800,000 in their retirement accounts. 60% of it is in bonds, just like their advisor recommended. They thought they were being conservative. But when I showed them what's happening in the bond market, Susan actually started crying because she realized that their safe portfolio could lose 20% of its purchasing power in the next 18 months if this trend continues. Here's what's really going on. The Federal Reserve has been trying to fight inflation by raising interest rates. And for a while, it worked. Inflation came down from 9% to around 3%. Victory, right? Not so fast. Because now we're seeing something that should terrify anyone living on a fixed income. Core inflation, the kind that strips out food and energy, is starting to tick back up, and the bond market sees it coming. Look at what happened in the 1970s. This is the parallel that keeps me up at night. In 1975, inflation dropped from 12% down to 5%. Everyone thought the crisis was over. The Fed declared victory. Retirees breathed a sigh of relief. And then, between 1977 and 1980, inflation roared back and hit 14%. People who thought they were safe in bonds and cash watched their retirement dreams dissolve. But here's where it gets really interesting. During that period, gold went from $140 an ounce to $850. That's a 500% gain. And it wasn't because gold investors were geniuses. It was because they understood something fundamental. When the bond market breaks, when inflation comes back, when the currency loses purchasing power, there's only one asset that's been a store of value for 5,000 years. Now, I want you to understand the mechanics of what's happening right now. The U.S. government is running a deficit of nearly $2 trillion a year. That means they have to issue new bonds constantly just to keep the lights on. But here's the problem. Foreign buyers are disappearing. China has been dumping U.S. treasuries for 2 years straight. Japan, which used to be our biggest buyer, is dealing with their own crisis and can't keep buying our debt. So who's left to buy all these bonds? The Federal Reserve. And when the Fed buys bonds, they create new money out of thin air. That's inflation by definition. It's not complicated. More dollars chasing the same amount of goods and services means each dollar buys less. Your retirement income buys less. Your savings buy less. Your bond portfolio buys less. I pulled up the data from the Treasury Department last week, and it's staggering. In the next 12 months, the U.S. government needs to refinance $7.6 trillion in debt. That's not new debt. That's just rolling over existing debt that's maturing. And they have to do it at higher interest rates than when they originally borrowed the money. Do you see the trap? Higher rates mean higher interest payments. Higher interest payments mean bigger deficits. Bigger deficits mean more bond issuance. More bond issuance means even higher rates. It's a death spiral. And here's what makes this different from any other time in history. The debt is so massive now that the government can't afford to let rates stay high. In the 1980s, when Paul Volcker raised rates to 20% to kill inflation, the national debt was less than $1 trillion. Today it's $36 trillion. If rates went to 20% now, the interest payments alone would consume the entire federal budget. It's mathematically impossible. So what does the Fed do? They're stuck between two terrible choices: keep rates high and watch the government go bankrupt, or cut rates and let inflation run wild. And I'll tell you right now what they're going to choose. They're going to cut rates. They have no choice. And when they do, that's when the bond market really breaks. Now, I know some of you are thinking, but my bonds are in a diversified portfolio. I've got stocks too. And that's good. But here's what happened in the 1970s that most people forget. Stocks didn't protect you from inflation either. The Dow Jones was at 1,000 in 1966. 13 years later, in 1979, it was still at 1,000. Zero gain. But inflation had cut the purchasing power of that money in half. You didn't lose money on paper, but you lost everything in real terms. You want to know what did work? Gold went from $35 an ounce in 1971 to $850 in 1980. Silver went from $1.50 to $50. These weren't speculative bubbles. They were monetary lifeboats for people who saw what was coming. And right now, we're seeing the exact same setup. Gold just hit $2,750 an ounce. But here's what's fascinating. It's not retail investors buying. It's central banks. In the last 2 years, central banks around the world have bought more gold than at any time since 1950. China, Russia, India, Turkey, Poland, they're all loading up. Why? Because they see what's coming in the bond market. They see the dollar losing its reserve currency status. They see inflation coming back, and they're protecting themselves. Let me tell you about what's happening with the BRICS nations. Brazil, Russia, India, China, South Africa. They're building an alternative to the dollar-based system. They're settling trade in their own currencies. They're backing those currencies with gold. And every time they do another deal without using dollars, it means less demand for U.S. treasuries. Less demand means lower prices. Lower prices mean higher yields. Higher yields mean your bond portfolio loses value. I was looking at the COMEX data yesterday, and something jumped out at me. The amount of physical gold backing the paper contracts has dropped to the lowest level in 5 years. There are now 350 paper claims for every ounce of physical gold in the COMEX vaults. Think about that. If even 1% of those paper holders demand physical delivery, the whole system breaks. And when it breaks, the price of physical gold is going to gap up so fast it'll make your head spin. You know what else is happening? The spread between paper gold and physical gold is widening. In a normal market, they trade at almost the same price. But right now, if you want to buy physical gold bars, you're paying $50 to $100 over the spot price. That's the market telling you that physical metal is becoming scarce. The smart money is taking delivery. They're not trusting the paper promises anymore. Now, here's where this gets personal for retirees. If you've got money in a 401k or an IRA, you probably think you can't own gold. Your advisor probably told you it's too risky, too volatile, doesn't pay dividends. But here's what they don't tell you. You can hold physical gold in a retirement account. It's called a gold IRA, and it's completely legal and IRS approved. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers exactly how to get physical gold into your retirement account without triggering taxes or penalties. Shows you the whole process, the custodians you can use, how the storage works, everything. Worth checking out if you want to protect your retirement from what's coming in the bond market. Anyway, back to the bigger picture, because what's happening right now isn't just about bonds or gold. It's about a fundamental shift in the global monetary system. And if you don't understand this shift, you're going to get crushed. Here's what I mean. For the last 50 years, since Nixon closed the gold window in 1971, the entire world has run on a system of fiat currencies backed by nothing but government promises. And the US dollar has been the king of that system. Every country needed dollars to buy oil, to settle international trade, to hold as reserves. That created artificial demand for dollars and for US Treasury bonds. But that system is breaking down right now. Saudi Arabia just announced they're willing to accept yuan for oil sales. That's massive. The petrodollar system, which has been the foundation of American financial dominance for 50 years, is crumbling. And when that goes, the demand for U.S. bonds goes with it. I want you to imagine what happens next. The Fed is forced to cut rates to keep the government solvent. But cutting rates with inflation still above 3% means real rates go negative. Negative real rates mean your bonds are guaranteed to lose purchasing power. So investors start dumping bonds. Bond prices fall. Yields spike. The Fed panics and starts buying bonds again, printing more money. That creates more inflation. It's a vicious cycle that ends with the currency losing significant value. And here's the thing that should terrify you. This isn't some far-off theoretical scenario. It's happening right now. The bond market is already breaking. The yield on the 10-year Treasury has jumped from 3.8% to 4.5% in just the last 2 months. That's a massive move in bond terms, and every tick higher means bond portfolios are losing value. I pulled up the numbers on what this means for a typical retiree portfolio. Let's say you've got $500,000 in bonds with an average duration of 7 years. If yields go up another 1%, which is entirely possible in the next 6 months, your bond portfolio loses $35,000 in value. That's 7% of your retirement savings gone, just like that. And that's before we even account for inflation eating away at the purchasing power of what's left. Now, some people will say, but if I hold the bonds to maturity, I get my principal back. That's technically true. But here's what they're missing. You get your principal back in dollars that are worth less. If inflation runs at 5% for the next 5 years, and your bonds are yielding 4%, you're losing 1% per year in real terms. Over 5 years, that's a 5% loss in purchasing power. You didn't lose money on paper, but you got poorer in reality. This is why gold matters. Gold doesn't have a yield, that's true, but it also doesn't have counterparty risk. It can't default. It can't be printed into oblivion. And historically, when bond markets break and inflation runs hot, gold preserves purchasing power. Not because gold goes up, but because the currency goes down. Let me give you a specific example from history that perfectly illustrates this. In 1971, when Nixon closed the gold window, gold was $35 an ounce. A new car cost about $3,500, so 1 ounce of gold bought 1% of a car. Today, gold is $2,650 an ounce. A new car costs about $48,000, so 1 ounce of gold still buys about 5.5% of a car. Actually, gold has gained purchasing power. But if you held dollars from 1971 to today, you lost 98% of your purchasing power. That's the difference. Gold maintains purchasing power across time. Bonds and cash lose purchasing power when governments print money and run deficits. And right now, we're in the biggest money-printing, deficit-spending era in human history. Here's another angle that nobody's talking about. The commercial banks are sitting on massive unrealized losses in their bond portfolios. The FDIC estimates that U.S. banks have over $600 billion in unrealized losses on their bond holdings. That's what happens when you buy bonds at low yields and then rates go up. The value of those bonds crashes. Remember Silicon Valley Bank? That's exactly what killed them. They bought long-term bonds when rates were near zero. Then the Fed raised rates. Those bonds lost value, depositors got scared and pulled their money, and the bank collapsed. And SVB wasn't some small regional bank. It was the 16th largest bank in America. If it can happen to them, it can happen to others. And here's the scary part. If more banks start failing because of bond losses, what do you think happens? The Fed has to step in and bail them out. And how do they do that? By printing more money, which creates more inflation, which makes your bonds worth even less. See the pattern? I was talking to a former Fed economist last month, and he told me something that chilled me to the bone. He said, the Fed knows they've lost control of inflation. They're just trying to manage the decline now. Think about that. The people in charge of our monetary system have given up on actually fixing the problem. They're just trying to keep the system from collapsing too quickly. And this is where we get into the really dark stuff. Because when a currency loses its purchasing power, it's not just an economic problem, it's a social problem, it's a political problem. History is full of examples of what happens when money fails. Weimar Germany, Zimbabwe, Venezuela, Argentina. It always starts the same way. Government overspending, money printing, bond market collapse, currency crisis. Now, I'm not saying the US is going to turn into Zimbabwe. We're still the world's largest economy. We still have the world's most powerful military. But we're not immune to the laws of economics. You can't print unlimited money without consequences. You can't run trillion-dollar deficits forever without the bond market eventually saying no, and that no is happening right now. The bond market is rejecting U.S. Treasuries at these prices. Yields are rising despite the Fed's best efforts to keep them down. And when the bond market revolts against a government, there are only two outcomes. Either the government slashes spending and raises taxes, which causes a depression, or they print money and let inflation run, which destroys the currency. Neither option is good for retirees living on fixed incomes. This is why I keep coming back to gold. Because in every single currency crisis in history, gold has been the escape hatch. It's not about getting rich. It's about not getting poor. It's about maintaining your purchasing power when everything else is losing value. And right now, we're seeing something unprecedented. Gold is hitting all-time highs, while the stock market is also near all-time highs. Normally, gold and stocks move in opposite directions. When stocks are up, gold is down, and vice versa. But right now, they're both going up. You know what that tells me? It tells me that smart investors are hedging. They're making money in stocks, but they're also buying gold as insurance because they see what's coming. The institutional money is way ahead of retail investors on this. Hedge funds have increased their gold positions by 40% in the last year. Family offices, the people who manage money for billionaires, are allocating 10 to 15% to gold, up from 2 to 3% 5 years ago. These are the smartest, most sophisticated investors in the world, and they're buying gold aggressively. And it's not just financial investors. Industrial users are stockpiling gold too. Electronics manufacturers, jewelry companies, they're all building inventory because they see the price going higher. When industrial users start hoarding a commodity, that's a massive bullish signal. It means they'd rather tie up capital in inventory than risk not being able to get supply later at any price. Here's something else that's fascinating. The gold mining companies can't keep up with demand. Global gold production has been flat for 5 years. The easy gold has already been mined. New discoveries are rare, and it takes 10-15 years to bring a new mine into production. So even if gold goes to $5,000 an ounce, which I think is entirely possible in the next 3 years, supply can't respond quickly. That's the setup for a massive squeeze. Demand is exploding, supply is constrained, and the paper market is over-leveraged. When that breaks, and it will break, the price of physical gold is going to go parabolic. Now, I want to bring this back to the bond market signal I mentioned at the beginning. Because everything I've been talking about, the inflation, the currency crisis, the gold surge, it all starts with what's happening in bonds right now. The yield curve steepening is the bond market's way of saying, we don't believe the Fed can keep inflation under control. When short-term rates are higher than long-term rates, that's an inverted curve, and it usually predicts a recession. But when the curve steepens, when long-term rates start rising faster than short-term rates, that's the bond market pricing in inflation and currency debasement. And here's the key insight. The bond market is always right eventually. The Fed can manipulate rates in the short term, but they can't control the long end of the curve forever. And right now, the long end is revolting. The 30-year Treasury yield has jumped from 4% to 4.8% in just 2 months. That's the bond market screaming that something is wrong. For retirees, this is the canary in the coal mine. Because if long-term rates keep rising, it means your bond portfolio keeps losing value. It means your fixed income buys less. It means your retirement plan, which was probably built on assumptions of 2 to 3% inflation and 4 or 5% bond yields, is broken. And here's the really scary part. Most financial advisors aren't adjusting for this. They're still using the same models they've used for 20 years. They're still telling retirees to hold 60% bonds and 40% stocks. They're still saying gold is too risky. But those models were built for a different world, a world where the government wasn't running $2 trillion deficits, where the Fed wasn't trapped, where the bond market wasn't breaking. I talked to a 72-year-old man last week named Robert. He's got $1.2 million in his IRA, all managed by a big-name brokerage firm. His advisor has him in 70% bonds because, at your age, you need to be conservative. But when I showed Robert what's happening in the bond market, when I explained that his conservative portfolio could lose 20–30% of its purchasing power in the next 2 years, he was furious. He felt betrayed. And he should feel betrayed because his advisor is following a playbook that doesn't work anymore. The old rules are dead. The 60–40 portfolio is dead. The idea that bonds are safe is dead. We're in a new paradigm now, and the people who don't adapt are going to get destroyed. So what do? First, you need to understand that this isn't about timing the market or making a quick profit. This is about protecting your purchasing power over the next 5 to 10 years. This is about making sure that the money you've saved for retirement can still buy groceries and pay bills when inflation is running at 5 to 7% instead of 2–3%. Second, you need to diversify out of traditional bonds. I'm not saying sell everything tomorrow, but if you've got 60–70% of your portfolio in bonds, that's way too much risk right now. You need to reduce that exposure and put some of that money into assets that protect against inflation and currency debasement. Gold is the obvious choice, but it's not the only choice. Real estate, commodities, even certain stocks can provide inflation protection. But gold is unique because it has no counterparty risk. It's not dependent on a company's earnings or a government's promises. It just is. And in a world where trust in institutions is breaking down, that matters more than ever. Third, you need to think about physical possession. I'm not saying bury gold bars in your backyard, but having some physical precious metals that you can access quickly is smart. Because if we do get a banking crisis, if we do get capital controls, if we do get a currency crisis, you want to have assets that aren't trapped in the financial system. The bond market is sending a signal right now that's impossible to ignore. It's telling us that the era of low inflation and stable currencies is over. It's telling us that the government's debt is unsustainable. It's telling us that the Fed is trapped and out of options. And it's telling us that the people who don't prepare for what's coming are going to lose everything they've worked for. This isn't fear-mongering. This is pattern recognition. This is understanding history and applying those lessons to what's happening right now. And the pattern is clear. When bond markets break, when governments print money to solve their problems, when currencies lose purchasing power, gold preserves wealth. You've spent your whole life working, saving, building a nest egg for retirement. Don't let the bond market collapse destroy it. Don't trust the old playbook that says bonds are safe. Don't believe the advisors who are still using models from a different era. Look at what's actually happening in the markets right now and protect yourself accordingly. The signal is flashing red. The bond market is breaking. And the time to act is now, before everyone else figures it out and it's too late.